Welcome everyone. Thanks very much for coming along to JobKeeper 2.0, the alternative tests. It has taken a bit of time to get through to this stage at this point. The tax office only just 1 week ago. And for those of you not as familiar and maybe over the time with the JobKeeper sessions, you're becoming a lot more aware of how laws are now done from a tax perspective. But basically Treasury comes out with the law, and then the ATO puts out how they're going to basically administer that law that Treasury has published. And so the alternative tests, the ATO did come out with how they were going to administer JobKeeper 2.0, but from the alternative test, they actually only released it last week, I think, so not even a week ago, to go through how they were going to go through the alternative test. We were expecting that these tests would be relatively consistent with the prior test, but we do have a few changes that have come through. So thanks very much for everyone coming along. We are working on a kind of a bit of a workbook calculation so that'll assist you in being able to go through those tests. So we'll come through with those as well. So my name's Shannon Smith. I've probably met many of you that are on the call today or on our webinar today. I'm actually not going to be the speaker. I'm going to be the moderator today. Paul Cunningham is going to be talking through and going through from a speaker perspective. I'll just get you to flick through, Paul, to the next one. For those of you, I think a lot of you have been on our sessions before. If you do have any questions, just pop it up into the questions, and we'll get through. If it's relevant, I'll address those questions during the session. And if not, we'll do that at the end and we can answer the questions. So we're thinking today is probably going to take about 35 minutes to go through the various tests that are available, and we'll focus on those main ones and have time at the end for questions if you have any. So just to introduce then our speaker today. So many of you might have had Paul Cunningham on our other webinars that we've conducted as well. So today Paul will be going through JobKeeper 2.0, and I'll hand it over to you, Paul. Thank you.
Thanks for that, Shannon. So I'll quickly start with what we'll cover today. So we'll start with when the alternative tests apply, and so that's just essentially a matter of determining, whether we are actually going to be eligible for the alternative tests. But before we even look at that, it is important to make sure that you to check the basic test first. If you pass the basic test, then the alternative tests aren't required. So even if you fall into one of the examples where the alternative test could apply to you, you don't actually need to look at it if you do already pass the basic tests. So that's important to know. You don't have to look at it. You only have to pass one of these tests, not multiple, even if the alternative does apply to you. Apologies, sorry. So as Shannon mentioned, that the law was passed and gave the ATO Commissioner some powers in order for the ATO Commissioner to set these alternative tests. So the law gave the Commissioner the power to set alternative tests for classes of entities, but not for particular entities themselves. So unfortunately, if you don't pass the basic test or these alternative tests, we can't go to the Commissioner and plead our case if we think it's unfair for whatever reason. Unfortunately, we are stuck with the tests that the ATO Commissioner has provided because he's not able to, the ATO Commissioner is unable to apply individual tests for individual entities. So hopefully we can get most of you in through the alternative tests if you don't meet the basic test. It is important to also remember that if the JobKeeper 2.0 is split into two parts. So you have the 28th September to, I think it's about the 3rd of January is the first period. And then from the 3rd of January onwards basically till the end of March is the second period. If you don't qualify for the first period, you can retest at December and qualify for the second period of JobKeeper payments, and vice versa. So you will need to run these tests twice to check your eligibility. We'll talk about some of the differences from the original versions as we go through, but some of the key differences I just wanted to highlight here was that we must use what goes on our BAS. So we cannot pick between cash or accrual where we could in the original JobKeeper tests. In this case, for JobKeeper 2.0, we have to use the accounting method that's on our BAS statements. And the other key significant difference is that we have to use actuals and not projections. So we can't project into October, November and looks like we're going to be down, so we need to JobKeeper to help. Unfortunately, your ability to access JobKeeper for the periods of October, November, December will relate solely, or not relate mainly to your turnover in September quarter, and your ability to access JobKeeper for January, February, March will relate to your December quarter GST turnover, what we call the test period. And we'll go through those today, the alternatives and how those work in a practical sense. So the basic conditions that need to be met to access JobKeeper 2.0. The first of these is that the entity must have carried on a business in Australia on the 1st of March 2020. And realistically, you need to have shown GST turnover before this period, which if you're carrying on a business, most likely that would be the case. The entity must pass the original declining turnover test. So presumably if you're looking at JobKeeper 2.0, that's because you were already applied and in JobKeeper 1. But it is important to know that if you were just looking to get in now, that you had to meet the conditions for JobKeeper 1. That being said, if you pass the tests for the September quarter, for the first part of JobKeeper 2.0, then you would likely pass any test for JobKeeper 1 as well. So, but it is important to, if you haven't assessed it for JobKeeper 1, you will need to do that as well. The additional part of that is the entity needs to pass an additional declining turnover test, and it's a separate test for each extension period. So as I mentioned before, for the first part of JobKeeper 2.0 rather, which encompasses payments from JobKeeper payments from relating to the 28th of September through to the 3rd of January, the entity must be able to show that the current GST turnover for the September 2020 quarter has dropped by the required amount in comparison with the GST turnover for the September 2019 quarter. So that's the basic test to meet that first half of the JobKeeper 2.0. To qualify for JobKeeper payments for the second period of JobKeeper 2.0, being from 4th of January 2021 to the 28th of March, the entity must be able to show that the current GST turnover for December 2020, call that the test period, quarter has dropped by the required amount compared with current GST turnover for the December 2019 quarter. So again, that's the basic test to meet the second part of it. So you will, whether you're in or out of the first part, you will need to retest again for the second part of JobKeeper. The turnover reduction thresholds have not changed. So 50% for entities with aggregated turnover of more than $1 billion, 30% for entities with aggregated turnover of $1 billion or less, and 15% for ACNC registered charities except schools and universities. You'll probably hear me refer to, when I go through the test, of 30%, because I'm assuming that probably most of you are in that bracket. So when to apply the alternative tests? So start with the basic. If the basic test, if you satisfy the basic test, then we don't need to even look at these alternative tests, even if you are eligible. So some of the alternative tests, for example, is a significant increase in turnover. That can still be the case, but you don't have to use the alternative test unless you fail the basic test. So start with there, then we look at the alternative tests. So the original declining turnover test for JobKeeper 1 looked at GST turnover, projected GST turnover for a test period, and compared that with the actual GST turnover for the corresponding period in the prior year. This new test compares, as I said, actual to actual. So there's a slight difference in the way, and there's a few differences in the way you're probably going to calculate your actuals versus your projected. And there's a few things that we want to discuss, just highlight at the top what may be included in your current GST turnover that maybe not everyone was aware of. So for example, in your actual GST turnover, you will include the sale of plant and equipment, for example. If you've sold an asset, a vehicle, something like that, and you've included GST on that, that will be also picked up in your GST turnover. You include in your current GST turnover also of taxable GST supplies, GST-free supplies that you make. Basically all GST supplies other than input tax supplies, which would be items like residential rent or financial supply, so would likely not be relevant to most people. Excluded from your GST turnover are supplies that are not connected with Australia. Just be careful here. If it's a GST-free export, it is connected with Australia, so it is included in that turnover value. What other items that are excluded is items that we've received that basically aren't for a supply. So we haven't done anything in particular to receive that money. So for example, JobKeeper payments aren't included in GST turnover. Cash flow boost amounts that we've received from the ATO on your BAS statements, they are not included in your GST turnover. And certain state government grants. So how the grants work for GST turnover is, did you have to provide or supply a service or a product to obtain that government grant? If you didn't have to do anything, if you just nominated yourself and said, I need a grant, can you please give me one? Then it's likely that you're not supplying anything, so therefore it wouldn't be included in the GST turnover. But if you actually provided a service or a product to get that grant, then there is a chance that it may be GSTable and may be included in the GST turnover. So as I mentioned, entities that are registered for GST must use the same accounting basis that is used for your BAS. So you can't pick whether you use accrual or cash. And I know that's going to be frustrating for many of our clients and many people out there, because there's, with the COVID and everything, there's been cash payment plans that have changed the way people operate. So you might not be getting the sales in at the moment, but you're getting cash for payments that were due quite a while ago, and so that may kick some people out, and that could cause a problem. But unfortunately, that is the way the rules are written, that you have to use the same accounting basis that is used in your BAS. If you are not registered for GST, so therefore you're not lodging a BAS, then you can choose either cash or accruals, and you can choose the one that best suits you. You must be consistent though. So when we say you must be consistent, if you're comparing, if your test period is cash, then the comparison period must be cash, and or vice versa. The test period's accruals, then the comparison period must be accruals also, just so that you're comparing apples with apples. Excuse me a moment. So as discussed, the ATO was given the power to come up with these alternative tests, which is why they took so long after the legislation. The ATO then had to go away and create these alternative tests. Some of them are similar in structure, but there are significant differences to the original version. Again, with all of these, it's important to note that we're talking about actuals. We're not talking about projections really at any stage. We're talking about actual GST turnover. In most of these alternative tests, there is sort of what I'm sort of calling is a two-step process. So the first is, do you pass the test to be able to use an alternative test? If the answer to that is yes, then you move into sort of that step two, where you're basically using your test period, be it September or December quarter, and you're changing the comparison period that you're comparing it to. So rather than comparing September to September, the alternative test should allow you to compare your September test period to another period, depending on which test you use. So there's two parts to it. You still have to show at some point a reduction of the relevant rate. So if it's for small businesses, most likely under $1 billion, well, for small businesses under $1 billion, it'll be 30%. You still have to show that 30% reduction at some stage. The alternative tests, and we'll go, the alternative tests, and we'll go through these in more detail. So entities that commence business before 1st of March, but after the relevant comparison period. So obviously if you started business in December, you don't have a comparison period for last September to compare with. So we'll go through how that works in practice. Business acquisition or disposal that had an impact on the entity's turnover, and any other restructures. What we're talking about internal restructures there. We'll talk briefly about how that can get you into an alternative test scenario. Business that have had a substantial increase in turnover. This is going to be one of the more popular tests, and we'll go through some examples in detail of how that works. Businesses affected by drought or natural disaster. I won't spend too much long on that. Don't think there'll be too many on here that would be applicable, but I just want to know that I want to make sure everyone knows that it is there, and if it does apply to you, then you can look into it more further, or even contact us and we can run through it with you in more detail. Businesses that have had irregular turnover, I think that's going to be another popular one as well, that and a substantial increase in turnover. I think everyone who doesn't pass the basic test should be looking at those just in case they might be eligible. And the final one there is the sole trader or partnership, where the business person has been affected by sickness, injury or leave during a comparison period. So we can talk about how that can be changed, so we can have a look at a different period potentially. So the new business test. So the business must have started, so any new business, to be eligible, you still must have started before 1st of March 2020. If you started your business after this time, then you won't get into JobKeeper at all. So you started before that date, but after the relevant comparison period. So we've got the dates there. So if you're testing for the September 2020 quarter, obviously that quarter starts 1 July 20. So if you must have started after 1 July 2019 to use the new business test, and obviously different dates for December. So there's two versions essentially. So some people will have access to one, some people will have access to both versions. You only have to pass one version. So you can test both, but as soon as you've passed one, then you're fine. So the first version, if for businesses that have started before the 1st of February 2020, is you add up the turnover for each whole month after the business started and before 1 March, that is, so you don't include the March 2020. And you divide this number by the number of whole months, so you basically get the monthly average, multiply it by 3 to essentially give you that comparison quarter that you're going to use. And then you can apply the test compared to September, so September 2020 or December if you're doing it later. So you can do the test period of September and compare that to that 3-month period number that you come up with. There's a table coming up that's going to show that in quite more detail as well. If you started your business in February of 2020, obviously you're not going to have any whole months to compare it to. So you take your turnover up to the 29th of February, you divide this number by the number of business days in February 2020 that you had, you multiply it by 29 to get to the month, and then multiply this by the number 3 to get to a quarterly number that you can compare to the test period of September 2020 or December as relevant. So this just shows it in a bit more of in a timeline sense. So for example, if you start a business on the 20th of October 19, then you ignore for this test the turnover for the rest of October. You start with the whole month, so November through to February. You take the whole turnover for that period, you divide it by 4 for November, December, January and February to get your monthly average, and then you multiply that by 3 to get a quarterly amount that you then compare to the September 2020 test period. And if you can show the relevant drop, so for most people will be 30%, then you will be able to access the JobKeeper 2.0. That's the first version. The second version can only be used if the business was started before 1st of December 2019. And this second version only refers to turnover for December, January and February. And this is a bit of a simpler version, but it's similar in operation. So you use the total turnover for those months, December, January and February, and you compare those figures with the relevant test period being either September or December quarter, and to see if you've got the 30% drop. And so this is here we can see same business again, started in 20th of October, but this time we can ignore the November period and we can just test for December, Jan and February, take that turnover for those 3 months and compare that to the September 2020 period to see if you've got the relevant drop. The next test that we're going to look at is just briefly is the business acquisition and disposal or restructure. So it's important to note these are internal restructures. So if you had a restructure of the entity, say you were a sole trader and then you moved from a sole trader to a company, this is not the kind of restructure that the tests are talking about. This is really what this is dealing with, is if you sold or purchased a business unit during that period, that is likely to affect your GST turnover. So I suspect that there's probably not going to be too many applicable in this, but we did want to highlight it there just in case it does apply. And in that case, you use the current GST turnover for the month immediately after any of the changes occurred. and multiply it by 3. Yep, there we go. So if you've got a change in business entity, for example, from a sole trader to a company, so that's not going to be covered in the restructure tests. Most likely that's going to be, you're going to be looking at sort of probably a new business test. So, but in order to do that, the company, for example, if you're moving from a sole trader to a company, the company would have had to have had business income before 1 March. So you're probably looking at alternative tests if that sort of is the case for you. Significant increase in turnover. Now, I think this is going to be one of the most popular tests because it essentially means that you can actually be having a better year this year than last year and still be applicable for the JobKeeper. So what we do is, and again, this is the first step, we need to make sure that we're eligible to use the alternative tests. Is we start by checking if there was an increase in turnover at least 50%, 25%, or 12.5% in the 12, 6, or 3 months before the test period. The addition here for JobKeeper 2.0 is that we can also use 50%, 25, 12.5, same numbers for the 12 months before the 1st of March 2020. So again, we only have to pass the test once in either format. We don't have to do both, but it gives you a couple of chances essentially to get into the test. So I've got a table here that really shows this in a little bit more detail. So you're looking at, if you're testing, our test period is the September quarter, for example. So the month immediately before is the month of June. So you're comparing the June turnover, so actual GST turnover for June 2020 month, pardon me, and you're comparing that with June 2019 for the 12 months and see if you've got that 50% increase in turnover. Same again, June 2020, but we're looking at 6 months, so back to December, and then so on for the 3 months. If that fails, then we can still look at the 12 months before the 1st of March. So we can test February 2020 to February 2019 for a 50% drop, or 6 months back for 25%, and so on. Similar rules apply, just with obviously different months for the December 2020 quarter. So there's a couple of chances to really get in there and be able to really apply these rules. And so if you do find that you have had what the ATO has determined as a substantial increase in any of these areas, then you can apply the alternative test. So if you use the period before the September 2020 quarter to see if there was a substantial increase, then your comparison period is now going to be the current GST turnover for April, May, and June. So the June quarter compared with your actuals for the September quarter. If you use the period 1 March, so the 12 months to the 1 March, to see if there was a substantial increase in turnover, you're now comparing your GST turnover for December, Jan, February with your September quarter, and you're still looking for that same 30% drop or relevant to your business. I'll just go through an example. Hopefully that is making sense, but I will just go through an example. So let's assume that the September 2020 quarter is the test period we want to determine whether there's been an increase in turnover of at least 25% for the previous 6 months. If the current GST turnover for the month of June 2020 was at least 25% more than the current GST turnover for the month of December 2019, then the test should be available. You then apply the test, which in this example involves comparing the current GST turnover, so your actual GST turnover for the June 2020 quarter, with the current GST turnover for September 2020 quarter, and you're looking for the drop that you need to then be able to access JobKeeper 2.0. So hopefully that's pretty clear, pretty clear to everyone. And so just to quickly just go back, and then obviously you could do the same tests in December as well with the relevant months, or you could have chosen the 1st of March, the turnover for the 1st of March. Just be wary, it does change the comparison period that you are looking at in that case. Drought or natural disaster, just briefly. So this is a test for those with businesses, or some of the businesses that were in a declared drought or natural disaster zone in 2019, and therefore do not have an appropriate comparison period. So I won't go into this one in more detail because I don't think this is probably going to apply to too many on here, but obviously just wanted to make you aware that that is available. So irregular turnover tests. So really important before we get into this is that the test can only apply if the entity's turnover is not cyclical. So if you have a business that produces, a large percentage of its income just in summer, for example, then it's highly likely that your entity's turnover is cyclical, and therefore you're not eligible for this test. This is a test for people who genuinely have irregular turnover, so they're not sure from one month to one quarter to the next how much turnover they're going to have, and therefore the comparison period might not necessarily be relevant for them, and we need to essentially smooth it out, the revenue over the 12 months to get a more true sense. So to satisfy step one, to be able to use the alternative tests, we need to ensure that either of the following two is satisfied. So the first is that the lowest, so we look at the 12 months before the test period, and we divide that into the 4 quarters. So if you're looking at the September as the test period, then the 12 months before ends on the 30th of June 2020. So we divide that into the normal quarters of September, December, March and June. And we're then looking at comparing the lowest turnover figure of those 4 quarters and seeing if that is 50% or lower than the highest of those of the GST turnover for those quarters. So we're basically showing that our lowest quarter is at least half of our highest quarter, which is demonstrating that, hey, we have a regular turnover and we need to have an alternative test. Similar to the substantial increase, we can also test from the 12 months before 1 March 2020. Same test again, you take the 12 months before 1 March 2020, you divide that into 4 equal lots, and you compare the GST turnover for each of them, or you calculate the GST turnover for each of those 4 quarters. You take the lowest one and check that if that is 50% or lower than the highest quarter for that period. If so, then you are eligible to use an alternative test. If the test is available, so you've calculated it and you do have an example of an irregular turnover, then you calculate the total turnover for each whole month in the 12 months immediately before the test period, or 1 March 2020, so depending on which one you use to qualify. And then once you do, you calculate the turnover for that whole year, that whole 12 months, divided by 12 to get your monthly average, and then you multiply it by 3 to get a quarterly result. And that is the figure that you use to compare to either September or December quarter as your relevant test period. So, for example, let's assume that the September 2020 quarter is the test period. We option 1, 12 months before 1 July 2020. We calculate the current GST turnover for each month from July 19 to June 2020 inclusive. We calculate the total turnover each consecutive 3-month period. We determine the lowest and highest 3-month turnover figure and check that the lowest figure is 50% less than the highest turnover figure. If we determine that that is the case, we can apply the test with reference to the total turnover for the July 19 to the 2020, so basically a 2020 financial year period, divide it by 12 to get the monthly average, and then multiply it by 3 to get a quarterly comparison amount, which we then compare with the September 2020 quarter to see if we've got the relevant drop for our entity. Another example, again, let's assume that September 2020 quarter is the test period. This time we're going to look at 12 months before 1st of March 2020. We calculate the current GST turnover for each month from March 2019 to February 2020 inclusive. We calculate the turnover for each of the consecutive 3-month periods, so divide it into equal quarters. We look at the lowest figure and check if that is 50% or less of the highest turnover figure for those quarters, and then we apply and if that is the case, then we can apply the test We get the total sales for that, total GST turnover for that period, March 19 to February 2020. We divide it by 12 to get the monthly average, and then multiply it by 3 to get a quarterly number that we can compare to our September 20 quarter to see if we've got the relevant drop. The sole trader small partnership. So this test can apply for a sole trader or a partner in a small partnership. And so a small partnership being 4 or fewer individual partners was sick, injured, or on leave during a relevant comparison period. It is important to note that this can only apply if the sole trader or small partnership does not employ anyone, and so has no employees at all. If that's the case, they can use the GST turnover for the month immediately before the month the individual didn't work and multiply this by 3 and have that as your comparative period to compare to your test period of either, September or December. Service entities, I will just touch on, I'm only going to touch on this briefly. This is a really complicated area, and so I would recommend that if you have multiple entities and you do have a service entity in your group structure, that you get in contact with us and we can have a chat over the phone and to go through what needs to be talked about. Essentially, service entities conduct the same basic test that any other entity would to see if they can pass the test and obtain JobKeeper. That being said, there is a focus on service entities and to make sure that there are basically the integrity rules to follow to make sure that there's a reason why that service entity that's most likely receiving income from another related party, there's a valid reason why that income has been reduced. So I would definitely recommend if you fall into that structure, then please give us a call and we can go through over the phone in quite some detail, because there's quite a few complications that in there with service entities for JobKeeper, and it's just not something that I think we have the time for today, and obviously doesn't concern everyone at all. So yeah. JobKeeper 2.0, so everything I've gone through today and a little bit more and a couple more examples is in our guidebook, which is downloadable from our website, and I believe will also be sent out in our emails as well when we send out the slides for this as well. So definitely I invite you to download the guidebook and have a review in detail, but please also don't forget to contact us if you have any questions. We also would like to invite you to like and subscribe to our YouTube channel. There we have lots and lots of video content. I was amazed myself last night when I looked at this and how much content we have on there. It really is awesome content. Lots of content for business owners to help you with JobKeeper, with Xero, with business advice, and just anything about improving your business and growing your business. I really recommend that you check this out. And I think I was a little bit quicker than I thought.
Yeah, and actually, so we've had a few questions, Paul. I don't know if you could maybe go back to the significant increase in turnover slide. And I know that that we've just had a few questions on that one, to just maybe go back, and that would be that would be one of the, I guess, probably one of the tests that others will be going through. If you could maybe just go back through that slide again, just to talk through when is it that they could use, so basically the significant increase in turnover, basically looking at how do you test that increase. There was just a few questions that came through about it. And I know when the guidance was first given out, we were kind of really scratching our head trying to get and put this into a more simplistic approach, because it is quite confusing the way in which they've written it as well. So one person's actually looking at, they were still confused about significant increase using the 3 months before 1st of March 2020. So
sure.
Yeah.
So if you're looking at your increase for example, you're looking at the 12 months before the 1st of March 2020, then, and if you're looking for the 3 months, so you're comparing your February 2020 turnover for that month with the turnover that you had in November 2019. And you're looking to show, so if you look at the, in this table, it's the bottom right corner, so the February 2020 turnover with the 3 months before the November 2019 turnover, and did you have in that 3 months an increase of 12.5% of your GST turnover? If the answer is yes, then you can apply the tests, and the test would be that you would compare your GST turnover for the periods of December 19, Jan 20, February 2020 with the September quarter to see if you had that relevant 30% drop. So I think this, I mean, I really, Shannon, I really got this when I looked at this table. I think that's really important to have a look at to see, to map that out. I'm not sure if we've got any documents that we can provide for that.
Yeah, so we've got that in our notes as well.
Yeah,
we
so
do have that
provide
table.
that. So
yeah,
so this table is essentially outlining what this is in written word, but it's just I do it I think in a much clearer way. So you look at if we're looking for at September quarter as our test period, and we've got two options. We can test the top row or the bottom row, and the table shows you the months that you're comparing. So June 2020 to June 2019 for the September quarter for the 12 months. And the top row shows you the threshold that you need to show an increase between those 2 months.
and that's to then be able to apply this test.
Yeah, so that gets you into the test. So you need to show an increase to say that I've had a significant increase in my business. That gives you the right to use a different comparison period to the basic test. I've gone too far, sorry. And so depending on whether you used the period just before the September quarter or just before 1st of March, that changes the comparison period that you're comparing to your test period of September to provide that drop. So you need to, in a strange way, you need to show an increase in one section, then you need to show a drop in another increase to be able to apply it.
Yeah, so you're still applying the drop, the test of the reduction. It's more just what's your comparison. So your standard test is that it's September 20 with September 19. If that's not possible, now we're looking at alternative tests that might be available, and then this is one of the alternative tests. If someone had asked, do you still need to have that drop? You still need to have the drop. We're now just applying a different test.
Pretty much in every single one of these examples, you still need to have the drop.
Yep.
Sorry, in every example, you still need to show a drop for businesses for 30%. You still need to show that drop. It's just changing the comparison period from what is in the basic test, September to September or December to December. It's just changing the period. It's just if you're allowed to change, checking if you're allowed to change the comparison period that you're checking.
Yeah. So I've got another few questions. Can you please advise if there's an alternative test for the situation where July to September 19 was an unusual quarter for us with an unusually low revenue, about 40% down on a 5 to 3 year average. So whilst July to September is down, it's only 25% behind July to September 19, but obviously about 50% behind if the past 3 to 5 years as a usual average. I would suggest on that one, if you're looking at it, is it probably looking at whether it's irregular income?
Yeah, I think the irregular turnover sounds like the best turnover. I mean, I would recommend that any entity that doesn't pass the basic have a look at least a significant increase in turnover and the irregular turnover, because some of those bars set in to apply aren't actually that high. So, like a 12.5% increase might not actually be that high, and you've got 12 in 3 months. Some might get that just by having some slightly irregular turnover. They might get that, be able to show that increase. So I would go through both tests definitely, because I think you're a chance to fall into other. And I've had examples already where I've been going through it, and we thought, for example, that they would satisfy the significant increase in turnover. They didn't, but they did satisfy the irregular turnover. So it's definitely worth looking at both, but it does sound like a regular turnover to me.
Yeah. So what happens if you didn't lodge a BAS last year, as you were not registered for GST, but now are registered for GST?
So if you weren't registered for GST back then, so you still would have had GST turnover, so you can still calculate the GST turnover, the actuals for that period. Obviously, you'll be restricted to what's on the accounting method that's now on your current BAS.
Yeah. So I'm a bit confused still with the growth business alternative. Maybe that might have clarified it when we've gone through that. If I'm a cash for BAS and I meet the increase in turnover thresholds, my understanding is that I compare the actual September quarter cash turnover with December, January, February, 3 months cash if I'm using the before 1st of March option.
So before 1st of March for the significant increase in turnover,
yep.
We're comparing December, January and February 2020.
Yep. So you're correct. Yes, that's right. Yeah.
And you're always using what's on your BAS. So
yep.
if you're using if it's cash, it's cash. Yeah.
Yeah. Another one, we run a very small business, 2 directors and 1 employee. Last September, the 2 directors had 1 month leave, so income during this time was limited and reduced. This now means that obviously we don't have a 30% reduction this year based on the September period last year. Do any of the tests? It may be one to look at that, basically the irregular, the significant increase in turnover, see if that applies, and the irregular turnover. This is one of the restrictions that we don't have. I guess you don't have any other flexibility around whether it's on a cash or accrual basis, and we don't have the flexibility like we did with JobKeeper 1.0 on being able to use projections. Yep. So there's some unfortunate situations that are happening as a result. So to try and get under the significant increase and see if you satisfy that test for any of those periods. So going back to that table that Paul went through, or irregular income. Another one, how do we provide the details of the alternative tests we used and our calculation qualifications through the business portal? Does it work on an honour system and we just keep the calculations available to present to the ATO if requested, or do we need to provide something more formal?
You won't need to provide anything, but I would definitely recommend that you have detailed calculations on hand just in case the ATO.
Yeah, I think you might get, so I guess if you're applying the alternative test, you're applying those because you didn't satisfy the basic test of September 20 compared to September 19. I would definitely keep your calculations because it's very easy for the ATO's risk engine to match your September BAS 20 to September 19 BAS, and if you didn't drop by 30%, you might get an automatic please explain letter for you to just highlight that. Another one, just to see if I understand correctly, for the rapid growth, if we pass the 50% increase, then we need to, you've got to go back to your table again, Paul. Yep, then we need to, back there. Then we need to compare the June 20. So if we pass the 50% increase, then we need to compare the June 20 quarter to the September 20 quarter and must show a 30% downturn. Is that correct? Let me get the table back up.
So if you've got your 50%, so you're checking the 50%, it depends where that 50% increase is. So if you're doing it, for example, if I'm looking at my 50% here, 50% column. So if we're doing it for September quarter and we're testing the 50% increases between June 2019 and June 2020, then we're basing it on the turnover immediately before the September 2020. And so therefore, we need to compare the current GST turnover for the June quarter with the September quarter. If we go back and if your 50% increase rather is in the 12-month period immediately preceding 1st of March, then you're looking at the bottom row of that 12-month column. You're comparing February 2020 to February 2019. If that's where you're showing a 50% increase, then your comparison period becomes December 19, Jan 2020, and February 2020, and that's what you're comparing to your September quarter. So in terms of which comparison period to use, it's not the number that's relevant, it's the what year are you comparing to, where are you getting that increase from. Yeah. Potentially you're in both, and so can therefore test both as well. So that it is entirely possible.
And then we have someone who arrived late and wants us to start from the beginning again if we can. No, then they joke they'll just watch the video recording. Yeah, so I think that's all the questions that we have. Yeah, if anyone has any other further questions.
Run through my slides again.
But there will be an email that goes out to you with the recording, but also with the notes that we've put together as well. And we are working on a kind of calculations to make it a bit easier. Apologies, it's all a bit late notice, but that was what the tax office did to us less than a week ago. Yeah, back to you, Paul.
Yep, so there's, if you do have any questions, please contact anyone in our leadership team, so Shannon, myself, or Daniel, we'll be all happy to take a call and run you through in detail. If you need to, we can talk about options there. And I think other than that is to say thank you, and please follow our socials.
Yep. Great. Thanks very much, everyone. Thank you.